everyone, Thomas Yao here at RDM Financial Group, Hightower Advisors. Let's discuss where markets and the economy stand today. We've seen modest gains recently, with risk-taking sentiment showing up in certain parts of the market, while more defensive areas have lagged. Although the mega-cap companies continue to capture the headlines, smaller companies have generally been doing better, and international markets have shown mixed performance, as currency movements even things out. In fixed income, the yield curve has steepened following the Federal Reserve's rate cut, with high-yield bonds showing relative strength and longer-term bonds trailing. Commodity markets have been mixed, with gold higher and oil holding steady. From an economic perspective, consumer spending has been resilient. Retail sales have grown for several months in a row, signaling healthy demand, even as inflation-adjusted growth looks more modest. Spending is uneven. Discretionary goods, like furniture, remain weak, but areas like online shopping and dining out are stronger. Industrial activity has stabilized somewhat, though the gains have been narrow and mainly tied to autos, while broader momentum is still lacking. Housing remains a soft spot. Construction activity has slowed, both in terms of new starts and permits, despite somewhat lower mortgage rates. Credit conditions are still tight, and this has implications for future supply, as well as the persistence of shelter-related inflation. Policy has also shifted. The Fed lowered interest rates by 25 basis points, framing it as a risk management step aimed at supporting a cooling labor market, while still keeping an eye on inflation. Importantly, the pace of easing through rate cuts is expected to be cautious, less aggressive than markets had anticipated. Inflation remains above target, but has shown signs of stabilizing, while the labor market is softening gradually, with slower job gains and unemployment edging higher. Globally, other central banks are also moving toward easing, which adds support for financial markets overall. Stepping back, markets are adjusting to a balance of forces. On one hand, we have resilient consumers, continued solid corporate fundamentals, and supportive central banks. On the other hand, housing remains weak, the labor market is losing some momentum, and valuations across many assets remain elevated. This combination means volatility is likely, but it can also create opportunity. Our approach remains focused on quality. Businesses with strong balance sheets, durable cash flows, and disciplined management. We continue to see long-term opportunity in themes such as artificial intelligence and energy infrastructure build-out, while also looking carefully at sectors that could benefit from lower rates in relation to housing and autos. Companies are showing renewed confidence through dividends, buybacks, capital spending, and even higher M&A activity, all of which support longer-term growth. Overall, risks remain, but the environment is constructive. Thank you for listening, and I look forward to speaking with you again soon.